Hi, I'm Pattu from freefincal. Today, let's talk about why gilt mutual funds and other debt fund categories fell to different extents over the last week and whether this will impact the stock market. If you notice, the gilt mutual funds fell between 1 to 2%, dynamic bond funds fell between 0.8 to 1%, banking and PSU funds fell, corporate bond funds fell, credit risk funds fell. Pretty much any debt funds holding medium and long term bonds would have gone down to different extents. The only funds that were spared were the overnight, the liquid, the money market, and probably the ultra short term to at least some of the funds. Why did this happen? And what does it mean? So the key player here is inflation. The inflation has gone up over the last few months, and RBI survey expects the inflation to go up to 10% in the coming 6 months or so, I think. And this means that RBI cannot keep reducing the interest rates, and therefore in the last meeting itself they had kept the rate unchanged. And when the rate is unchanged, what this means is the bond market expects that the next meeting the rate will be higher, new bonds will be available with higher interest rates, so they will not buy the old bonds. So the demand for the old bonds will come down, the value of the old bonds will come down. When the value comes down, the mutual funds holding those bonds will have a lower NAV, and therefore you have a fall in the NAV. Of course, RBI tried to control the situation by buying back some of the bonds. They bought those government bonds, something like 4-year bond, 7-year bond, 10-year bond, 12-year bond. They bought all those bonds back. They created some kind of a demand. This is in a sense artificial demand, so they bolstered the value of these bonds, but they can't keep doing that. There is no escape from the fact that retail inflation is going to increase, and this means that the interest rates have to go up. I had written in an article yesterday about the case of Argentina, where they have inflation of 50% or so. The bank interest rates are very, very high. So in higher interest rate, suppose they increase the interest rate of PPF back to 8% or so in the coming months, that's going to happen in my opinion. There's no choice from there. That is not a good thing for you, because that means you are going to, inflation is higher, then you are going to have less money in your hands. You're going to spend more on your day-to-day expenses. So the interest rate may be higher, but the amount you put in will be low. So that's not actually a good thing. So this is also a bad news for the stock market, because the borrowing rate by the firms would be higher, so it would be difficult for them to sustain their production. Already they are under tremendous stress because of the lockdown and such things. And the way you can understand this is by looking at the bond yield. The demand and supply in the market is measured by the bond yield, which is defined as the interest income divided by the current price. So when the price is, like I said, when there is no demand, the price will fall. When the price falls, the bond yield moves up. So there's an inverse relationship, so there's a lot of confusion. So the best way to do it is to plot the inverse yield. If you plot the inverse yield, then it will be current price by interest income, and you can see that this is the inverse of the yield, and you can see how the inverse yield dropped. It has been dropping for the last couple of months or so, from July maybe. Gradually it was falling down, and then it drastically fell down, and then RBI took some steps, and it increased a little bit, and then it's fluctuated there. Today again it increased a little bit, and so on. You can see this in the NAV of the 10-year SBI fund, the SBI Magnum Constant Maturity Fund, and the CRISIL 10-year bond index. You can see both of them falling down sharply like that. Of course, they reacted sharply upwards when the interest rates fell. Now when the interest rates are more or less go steady, and the possibility of the interest rates going up, then they will that's why they've started falling down. So this is a problem. And if you are invested in gilt funds, if you are invested for the short term, please be aware that such things can make your returns very volatile, and you could even get negative returns from gilt funds. Those who are invested for the long term gilt funds should not worry too much about it. They should use these as rebalancing opportunities and handle the portfolio as usual, but they must understand that this is going to if the interest rates are going to go up, so the interest rates have been falling down like this, and now they're going to go up, and throughout that upward cycle they are going to have all the debt funds are going to bleed, all the long term bonds will bleed. What many people fail to realize is, even if you are holding, let us say, a 7-year corporate bond, let's say from Shriram Transport or something like that, some company, it's got nothing to do with the government, but because the 7-year gilt and the 7-year corporate bond, they are linked together in a sense that the risk premium of the Shriram bond will be higher than the gilt. And the gilt has no risk basically, at least to the resident Indian, and there is a return, there's a yield on that bond, but the bond given by this issuer should be higher than the coupon rate should be higher, therefore because the risk is higher, and that's the risk premium. The risk premium of all the bonds will be linked together. So if the gilts are going to fluctuate in value and demand and supply, then all the others will also, other segments of the in the credit rating scale would also fluctuate accordingly. So everything will get affected except perhaps in the short term cycle. Of course, if the interest rates do increase, then the short term bonds may do well, but that's again cyclic, so you have to be careful about how you interpret that and so on. So will it affect the stock market? Yes, I expect it to affect the stock market. I have been talking about the possibility of a sideways market for a long time now. It's not big up movements or big down movements you should worry about, because if there's a big up movement, suddenly it'll suddenly fall down quickly enough. If there is a big fall, it'll quickly move up. We talked about volatility bunching in a few videos ago. That's not what you should worry about in a stock market. In a stock market, the biggest worry is nothing happening. It just goes on like that. If that is going to happen sooner or later, because the market is gradually moving every day, it's kind of waiting. Some people say once the vaccine comes, everything will be okay. No, I don't think so. It's going to take us at least 1 year, maybe more than that, to have that money supply normalized, its productivity to come back up, demand to come back up. There's going to take some time. So the stock market will wait, and of course it will react to some terrible bad news. If there's no terrible bad news or anything like that, it's going to just wait, because the inflation is rising, borrowing is going to be difficult, so it will definitely impact stock market return. So don't expect anything fantastic in the coming years. But if your need is several years away, several decades away, this is a fantastic time to accumulate. Stop asking, is this a good time to invest? Shall I wait for Nifty to do this? Waste of time. That such things, it's just idiocy. Just start accumulating as much as possible when there is some kind of uncertainty in the market. When the market zooms up, your life will change if you have enough money invested. So that's what I keep saying all the time. You have to just follow it, but I find many people not doing it. Anyway, bye bye.